Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 175. On today's episode, we're going to talk about what everybody else is talking about, which seems to be, is there an AI bubble? Is it the same as 1999? Should we be worried? Should you be concerned about your portfolio? How do I manage this? How do I navigate this? And we're going to talk about some things you can do when looking at your portfolio and how maybe you can take advantage of this. And also just know the differences between what went on then and what's going on now. So as always, get your mind right and let's get to work. Well, welcome back to the podcast, everybody. Sorry for the absence. I'm going to go, I ordered all this really, fancy new podcast equipment, and then I got it in and I could not figure out how to get it to work. And I was like, okay, I'm just going to go back to admitting that I'm old, and I'm going to go back to what I know works. And so I plugged in the old equipment and here we are. So we'll see. But we look around, and September historically, I even said, like, don't be surprised if September's a bad month. It turns out that September really wasn't, that bad. And so now all of a sudden you have everybody kind of looking around, almost like, Groundhog Day, everybody looking around, popping up, going, is this all right? How we looking? All of a sudden we look like we're going to have, a pretty good year here. So we got the Dow Jones up 9.9%, so just shy of 10%. We have the NASDAQ up 17% for the year, almost 18% for the year, and we have the S&P 500 up 14%. And so everything is looking pretty good. And so all of a sudden you have all this conversation, all this talk about, is there an AI bubble? Is this 1999? And it really just needs to be addressed a little bit. And so the one thing that I would like to say is that when everybody's talking about, is there a bubble, when there's this big concern, it's actually a good thing. It actually kind of keeps a lid on prices, because everybody's like, okay, let's not get too ahead of ourselves. Let's not be too exuberant about stocks. But you do see that there are going to be areas of the market, just like we had in 2021, that are going to get ahead of themselves. And so that's kind of what ends up happening when you look at market psychology, is you get this thing called projection bias, which is basically, we go, man, the last year or two have been great. And we just project that into the future, saying that the market is going to continue to do well. And so you have to be careful with that. You have to, when the market's doing great, you got to think about when the market isn't doing well. And, when the market isn't doing well, you have to think about when the market is going to do well once again. And so you can't, it's great to be cognizant of it, but don't let it just kind of completely, dictate like the actions that you're taking inside of your portfolio. But it is something to be aware of. So I would like to think about, like, picks and shovels. So we think about AI and think about companies that are making money from AI. So these are going to be companies that are, making the chips. They're basically providing the infrastructure for AI. So that's going to be the Nvidias of the world. That's going to be Broadcom. That's going to be, ASML, who makes the machines that makes the chip. It's going to be Taiwan Semiconductor. It's going to be the companies that are going into building the data centers. So you look at the infrastructure build out there. I will say, so this past week I traveled to Midland, Texas to see some clients. And on my way back, I went through Abilene, Texas, which has the building of OpenAI's one of OpenAI's data centers, which is called Stargate 1. So I typed in, data center on my Google Maps, and I said, I want to go see this thing. So on the way home, I went through Abilene and I looked up Stargate 1 and I went to go see it. And let me tell you, like, went down one road and they had these concrete barriers. I think they're called New Jersey barriers, the concrete ones that kind of block you in on the highway. So they had those like at the end of one road, and I was like, okay, so nobody passes this point. And then I went to another way around to try to get up to it, and it had a gate and a security guard. I'm sure they ran my license plate, I don't know, 2 miles before I got there, but it was unbelievably secure. And I was like, okay, well, I guess I'm not going to see this thing. But from the highway, I mean, I could see, as I'm getting closer, you can see it from the highway. I mean, I can't even describe like how big this thing is. I mean, I'm guessing, I don't know, like 10 football fields long. I mean, it's just absolutely incredible. So I'm thinking about, okay, so you have OpenAI spending all this money on this infrastructure. And so who are the companies that are building this out? Well, obviously, there's a lot of contractors, there's those, but I'm thinking about companies like APH, which is Amphenol, which makes electrical connectors. And so think about like where all this money is being spent. It's the picks and shovels, right? There's an old joke that said, who got rich during the gold rush? And the answer to it is the people that sold the picks and the shovels, right? That as people were passing through, it's like, oh, I need a shovel to dig. So, those are the people, that made the money. And there will be companies, anytime we have this, there are companies that don't work out. Like there's companies that are big companies that are going to, that are not going to make it. And so, we look here, we look at where the money's being spent. It's these companies plus infrastructure. And then you have to ask yourself, where is the froth in the market? Where's the hope? Where's the hype? What are the companies saying? I'm investing in in AI, and then later on it's going to improve what I'm doing, right? I mean, so and we see this on reports like Meta already said that because of AI, they're able to better predict what you're willing to click on in your Instagram feed, your Facebook feed. They've already been able to use that to help improve, like I think 5% for you to click on their ads, 5% more, which doesn't sound like a lot, but when you look at a company like Meta, I mean, it's a big number. And so you look at those companies, and then I think like when you look at more kind of on the fringe, I mean, there's a lot of software as a service companies that say that they're going to be using AI, and that's going to be the Salesforces of the world. I think those are the ones where it's a little bit like, are they converting that? Is it actually increasing are their customers getting more benefit by using them? Are those customers willing to pay more for that? Because at some point, that's what we're looking at here, which is at some point, Wall Street's going to be like, okay, you've spent all this money, you've spent all this capital on AI. Where's the return? Because at the end of the day, that's what investing is. Investing is I'm taking some capital, I'm investing over here, and I expect a return on my money. Well, at these levels, the amount of money that these companies are spending, at some point, and that's the hard part, is you don't know what piece of that, when is that going to be? Investors all of a sudden are going to expect a return on their money. And so, but for now, when you look at Nvidia, you look at some Broadcom, you look at the margin these are very, very profitable companies. And when I say very profitable companies, I mean like most profitable companies the world has ever seen ever, which doesn't mean that they can't be overvalued, but it's different from 1999 when it was really all about hopes and really about hopes, dreams, and websites and the internet adoption. And a lot of those companies, they just weren't making money yet. And so that's the switch I see. That is the thing that I'm paying attention to, is because what makes me a little bit nervous is that for most of this AI expansion that we've seen, a lot of this has been companies spending free cash flow. So this is companies spending out of money they're already making. So Nvidia is spending out of money they're making. Meta spending out of money they're making. They're not borrowing money, which is what a lot of companies did back in 1999, is they borrowed money to set up whatever they were going to be doing, and the revenue never came. And so one of the things that makes me nervous is now you look at a company like Oracle who signed this big contract with OpenAI. OpenAI is still a private company. And Oracle said that they're going to have to borrow money in order to be able to kind of build out the infrastructure that they need for OpenAI. And so this is where we get like, okay, do we need to be a little nervous about this? Is this something we need to be, this is where it could change, because OpenAI as a private company has promised all these contracts, all of these things, but it's harder to raise capital as a private company than it is a public company. And so if something were to happen, that domino, if that OpenAI domino were to fall, it's going to impact a lot of companies. So you have to be aware of that. But the adoption for AI looks to be much faster and quicker than it was for the internet. If you think about like 1999, everybody's going to use the internet, but it just took a lot longer than was expected. All the websites to go up and being able to actually buy something, if you're, which most of you aren't, but if you ever remember what it was like to buy something on Amazon at first, I mean, it's just real clunky. This seems to be where it's going to be integrated much quicker. Now, this again goes to being very aware of what you own in your portfolios. And so this is when I get nervous with how many investors are in just mutual funds, index funds, and they don't realize that a lot of those index funds and mutual funds that they own the same things over and over and over again. And so that is the part that makes me nervous, because, I looked at a portfolio this week. They had 4 mutual funds, and inside of those 4 mutual funds, 3 of them, their top 10s, the top 10 holdings that those mutual funds own, they were all the same. They were completely the same. And so, my advice to that person was like, man, these all own the same thing. So if the market does, go down, or if we have a pullback, you're going to feel it 3 times as much because you have such high concentration. So that's the worry for a lot of investors, is that whatever they're invested in, they feel like they're diversified and they're not. So if you own Nvidia outright and you know that it's 5% of your portfolio, then it's easy to be like, okay, it's 5% of my portfolio. But most investors can't see that. They don't have that level of clarity inside of their portfolio. So you just have to be cognizant. And, it's okay to take a profit. We talk about this a lot, but it's okay to take a profit. And, if you've been investing over the last couple of years, you probably have a lot of profit. And so that's the hard part is, should I take profit? Should I put that cash on the sideline? How much longer is this going to last? All of those things. But if you're in it for the long haul, you shouldn't be too concerned. I always look at like, would you rather invest at the top of a market versus not investing at all? And for the most part, the stock market goes up and to the right. So the charts are going up. But it's not a straight line. And so if you're worried about, man, the market's high, I should have, invest small. There's no rules that say you got to invest it all at once or whatever. I mean, you can buy small as you go to try to help that. But the most important thing is to think about it always, always, always comes back to what kind of companies are you investing in? Is it speculation? Those kind of things. So another OpenAI kind of speculation right now has been all like the nuclear stocks. And, it's fine to invest in some of those, but you just have to realize that you're speculating on, is nuclear going to be the way to power the data centers? I mean, all these kind of unknowns that we have, it doesn't mean you can't invest in them. You just have to be aware, okay, this is a risk. Like this company doesn't have earnings yet. I'm, investing, expecting these earnings to show up later on. And if that thesis changes, I got to be willing to get out. So, I mean, this is when using a stop loss, even using limit orders to buy shares on a day where you're like, okay, I'm gonna wait for this to calm down a little bit. I'm gonna buy a little bit lower. You can use limit orders, stop orders, all of those things. We have earnings coming up in a couple weeks. I didn't even mention it at the top of the show, but right now the government is shut down. Normally, That impacts the market by about 5%. I mean, on most government shutdowns, we would see the market drop about 5%. We haven't seen it yet. I mean, I'm guessing the longer the shutdown goes on, the more likely we are to see some kind of impact. But I think, when you look around, the market's probably a little politically fatigued, I guess I would say, because there has been just so many news stories, so many political news stories that have come out this year that it's kind of easy to be like, oh, geez, another more news out of Washington type of deal. So we have to monitor that. We have company earnings coming out, and so it's not a bad time to look at your portfolio and say, okay, is there some things here that I think have gotten a little high? Maybe I should trim, be disciplined. Remember, if you're fully invested right now, I mean, it's hard to invest on a pullback if you don't have any cash on the sidelines. So you might want to think about, okay, I've made some good money here. Maybe I need to trim some of these, and then that way I have cash to invest if the market does pull back, like it did in April. I mean, that was a pretty good opportunity to be able to buy some shares. So, always kind of keep that in mind. It should be painful on both sides, and I know I've said this before, but it should be painful on both sides. I mean, when you trim a little bit, you should be like, man, why am I trimming this stock? It keeps going up. And then also on the other side is like, man, why am I buying this stock? All it does is keep going down. So just kind of keep those things in mind. I would also say that because there's so much money going into the AI stocks, the technology stocks, this gives you a good opportunity to kind of look for areas that other investors aren't paying attention to. So this could be something like United Healthcare that has basically been cut in half and left kind of just the worst Dow performer of the year. You could look at something like Nike, which might be a good turnaround story. Their numbers looked pretty good this week. You could look at some of the oil companies, where those haven't performed well this year. So there's little areas of the market that you could take some of the money that you've made in technology, in AI, trim that back, and then beef up your portfolio on kind of the safer, more stalwart type companies that maybe just have kind of been overlooked, because you got to remember the money's got to come from somewhere. So if everybody's buying technology stocks or AI stocks, I mean, they're selling probably some pretty good companies somewhere else. And so that allows you to be able to kind of sneak in there and accumulate those shares, and always be thinking about, like, I'm constantly thinking, like, what am I going to make money on like 2 to 3 years from now? Not 2 to 3 weeks, not 2 to 3 months, but what is kind of out there down the road that maybe somebody's not thinking about, that I think that, could be a pretty good spot for me to invest. And so that seems to kind of allow me to think about companies that have kind of been overlooked and might provide a good opportunity. And you'll see those, like, if the Fed continues to drop interest rates, a company like Procter & Gamble, which has not had a good year this year, if the Fed continues to lower interest rates, well, all of a sudden, like, CD rates and those kind of things they're not going to provide the yield that a lot of investors might need, or especially retired investors might need. And so all of a sudden, a company like Procter & Gamble, in their yield, they've raised their dividends 69 years in a row. All of a sudden, that looks pretty good. And I will say that Warren Buffett and Berkshire Hathaway this week, they bought out OxyChem from Occidental Petroleum, which Buffett is also a huge investor in. I believe, don't quote me on this number, but I believe he owns about 27, or not he, but Berkshire Hathaway owns about 27% of Oxy. And so they purchased OxyChem, which was a chemical division of Oxy, this past week for $10 billion. And what that's going to allow Occidental Petroleum to do is it's going to allow them to pay down some debt. So it's going to allow them to pay down some debt. It's going to save them interest expense. And so that should help, Oxy stock long term, should help them be able to pay down more debt and then also start to return some capital to shareholders. So, oil's been kind of muted this year. And so that allows you to have kind of the opportunity to look at those as well. And kind of, I don't know if it's a big announcement, but I've been telling you recently, I've done a lot of done a lot of compliance stuff. My investment firm, Rydar Equities, is now registered with the SEC. And with that comes, more compliance and things like that. But there is a benefit to you, the listener. So if you've ever wondered, like, what does Ryan Peckham invest in, or what does he invest his clients in? You can now go see. So there is a website called WhaleWisdom. So well as in WHALE. And I have used, this is kind of a full circle moment. Like, I have used this website for years because it allowed me to see what some of my mentors, Warren Buffett, Guy Spear, all the people you've heard me talk about, I could actually go on there and see what they invested in. Well, if you go there and in the search bar, you type in the firm name, my firm's name, Rydar Equities, you will see the investments that I have invested my clients in. So it actually has it kind of in order from the thing that we own the most all the way down. And so this is something that I have to update quarterly. And so you have to understand it's always 3 months behind. And one of the things I noticed on the website too, is it actually shows you what it estimates the average price that I paid for those shares. And I will tell you that it's wrong. So when you go look at that and you see like what the average shares, it's because I just recently had to start filing this because the firm got to a certain size where it's required. And so it's using that estimated cost as like when I first had to report this. And so I will unequivocally tell you that is the wrong, those are not at the actual prices that I paid. I guess when I add a new position, because right now they all show new, but when I add a new position, it would probably be more accurate. But the ones that are on there now are definitely not accurate. So the number one investment that the firm that we have for clients is Apple. And I think the firm position in Apple right now is close to $9 million worth. And we didn't pay anywhere close to $9 million. I think the cost basis of the firm is probably, $3.5 million, something like that. So, but anyways, it might be helpful for you to kind of go see what are the stocks that we're looking at, what have we actually invested in. And so, just kind of a way for you to see that. So as always, I hope this was helpful for you. Don't mistake activity for achievement, and I'll see you next time. Thanks, everybody. This podcast contains general information that may not be suitable for everyone. The information contained here should not be construed as personalized investment advice. There is no guarantee that the views and opinions expressed in this podcast will come to pass. Investing in the stock market involves gains and losses and may not be suitable for all investors. Information presented here is subject to change without notice and should not be considered as a solicitation to buy or sell any security. Rydar Equities does not offer legal or tax advice. Please consult the appropriate professional regarding your individual circumstance. Past performance is no guarantee of future results.